What's up, guys? It's Alicia here with Keller Williams South Tampa, coming at you for a very special Mortgage Mythbusters Millennial Monday.
Yeah, what's up?
Featuring Chance Unger VanDyk Mortgage.
Hello, everyone.
I want to bust some myths that I've heard a lot of millennials talking about, a lot of misconceptions when it comes to buying a home. I'm just going to pitch you some of the objections I hear on a daily basis.
Cool, bring it.
So, Chance, I'm a millennial, and I'm trying to make ends meet right now. I don't really have a lot of money for a down payment. I can't put 20% down, so how could I possibly buy a house?
Yeah, so a lot of people say the same exact thing, Alicia, is, they're always concerned about dropping 20% down. And the common misconception is, I got to put 20% down to get rid of mortgage insurance, right? Well, that's not always the case. Nowadays, no. Let's keep more, liquid in the bank for you. Okay. So let's talk about 5% down. Let's talk about 10% down if you want to get a little bit more friskier, right?
Okay.
And then we can still look at getting rid of mortgage insurance in a few different options. We can either finance the mortgage insurance into the loan. You can stick with paying for your mortgage insurance monthly, which a lot of people tend to do. Or we do what we call a single premium. Pay for it at closing, cash, boom, bam, get it out of the way.
And then from the realtor perspective, I will say this, you want to make sure that you've got a nest egg before you enter your home purchase, right? You need to have money set aside. You have to anticipate that something's going to happen. You are the landlord. You can't just call someone, right? Chance, like everyone else, I was told I had to go to college in order to make a decent living for myself, right? I even got a scholarship, and I still racked up a ton of student loan debt. So there's no way that I just have too much student loan debt to buy a house. I don't see how that could happen.
Yeah, well, you know what? Welcome to 99% of everyone else in the nation. And guess what? They're still buying houses, okay? Now, what we do is we do have to count student debts into your debt ratios, okay? But there's a few different ways we can approach it. So if you have a fixed payment arranged with them already, cool. We'll go off of that. If not, if it's in deferment or if it's being pushed back because you're still going to school, all right, then no problem there. What we do is we take the total amount and we factor 1% of that, okay? And that 1% is what we use to calculate against the debt ratios. On conventional side, what we'll do is we can either do the 1% calculation into it. If you're in an income-based repayment plan, we'll use that income-based payment program. Or if you have the fixed payment already arranged, then we use that as well too.
Chance, I'm younger. I've made some mistakes with my money. No one really explained the importance of developing good credit. So how could I possibly buy a house if I don't have really great, perfect credit?
Credit-wise. Yeah, if you got some distressed credit, if it's a little bit lower than normal, let's look at it. But we can go as low as 580. 580. But 580 is as low as we can go. I will be completely transparent with you, though. They are uglier than Frankenstein. The pricing's not going to be favorable for you. We're going to have to do a lot of hoop jumping here. And, if I'm not double dutching in a schoolyard, then I don't want to be jumping, any more than I have to. If you're about a 640 or higher, things are looking a little bit more favorable. We could definitely make a little bit more magic happen there. So.
It's our jobs to vet you and credit scores. Those will just dictate your interest rates primarily. But don't count yourself out. Chance, what about the housing crisis? We're back in a bubble, right? This bubble's going to burst, and I'm going to lose everything I put into my house, and I'm going to have nothing.
Hold on. We're in a crisis right now? Because as far as I know, things are still going great. And here's why, though, okay? Back in 2009, yeah, people got reckless. It was the Wild West. People stayed at everything, right?
Right.
Yeah, you make all this money. Oh, you got all this assets. Perfect. Here's a mortgage for $1 million. Go have fun. Next thing you know, there goes the bubble popping. Ever since that happened, a lot of regulations came on board. The other thing I would definitely say is a lot of people are throwing a lot of skin in on the game nowadays.
Yeah.
Now people are actually putting 15, 20, 25% down on property. I think as everything else in life, with corrections and whatnot, you got to have balance. But are we going to sit here and do a nosedive into the abyss? No.
Right.
No, I don't think so at all.
Let's not pretend that didn't happen, right? It definitely happened. You're just fearful because you saw what happened and you don't want to fall for the same traps, same tricks. And I know that in a lot of ways, millennials are really reinventing a lot of wheels, but the housing industry is one where we really don't have to do a whole lot of reinventing.
Mm-hmm.
Right now, we're in a way better position. We've got way better regulations going on.
Oh, yeah.
All right, guys, so this is what we do. He does mortgages for a living. I do real estate. We love this stuff, guys. We're happy to answer any questions that you have. But I think as of right now, I think we just busted some myths.
I think we just did. Boom! Right?
Ooh.
So there you go. Oh, yeah!
All right, guys. Thank you so much for tuning in for this episode. I'm going to go ahead and put Chance's info in this for you. I'll put his number down below here. You know where to find me. Y'all just take care. Have a great week.
All right. See you guys.